Good morning to the MMTs. And what do we have? A weekly chart on that S&P 500. We know that the daily chart is at, excuse me, something got in the way. We know that the daily chart has a 200-day simple moving average around 1380, and we cracked it. But look at the reason I'm going to calendar 2009 all-time lows. It comes where the 2011, every time that we had a correction in the S&P, we made higher highs. We reversed in calendar 2011. It was a year ago at the same time frame, November, December, that we were buying down here, and then we had that great rally up here. Then look at that great weekly sell down from the 2012 period up to 5.5 year highs in the S&P to 1475. We hit our target, and we've dropped only through the selling of this period of this great bull run in the S&P, but only dropped 100 points off of there. Let's get down into a little bit more macro part of this. Let's just take the calendar 2011 lows. 1 week, two, this is the third week below the 10-week simple moving average. That's a blue line. We have fallen through the 20-week, as we have said. This major rising 50-week moving average on the weekly chart is going to be a major catalyst of support. So let's just draw a horizontal trend line slightly above it. This is exactly where we had from the last correction of 2012, correction 1. We have correction number 2 in play. But let us take a look at where that longer, broader part of that move was during this bull move. This was the first bull move that starts right here, and it started right here in January. And you can see right here at the low, we topped, we sold. We've topped and we're selling. This was the greater part of the bull run in that 5.5 year high that everyone talked about over the summer period. But now we are in the 2 best months of the year, and I can tell you from a weekly level, just by looking at it, that we're short-term oversold, but not oversold. What I will tell people is that any run up into the S&P, the 20-week moving average is going to be 1409. That's going to be the wall of resistance now. And that if we sell through the 50-week, the broader part or the bigger picture is going to be right here at about 1320 on the S&P 500 now. So it's very important for you to understand that this diagonal trend line that comes off the 2009 lows, the whole thing doesn't break until you break below this longer term diagonal trend line here now. So let's go back and take a look at where that was coming from now. That's coming from over here, from the 2009 lows. That's right there. And it comes right through the 2009 low to the 2011 reversal low to all-time highs, and the S&P is at heavy risk right now. I will tell you one thing. November, December is supposed to be the best months of the year, but we are in a broken down bear reversal. Until I'm back above that 10-week and closing above the 20-week, I will not be back in that bull. That bull, yes, there's a longer term bull, but the shorter term, we're in a bear reversal, not a bull run. So let's establish that if this 10-week keeps declining, and if we break and sell below the 50-week, we're going to come right back down here. This is going to be that diagonal trend line off the 2009 lows that sits right there, and it's right above the 100-week. The 100-week moving average is rising. So is the 50-week. All of the weekly moving averages are rising, as everything a bull would want to see in weekly moving averages now, from a standard deviation technical model called standard technical analysis. But let us not forget one thing. If we continue to break down, if there isn't any resolution, it's all about these tax cuts. There's 2 different kinds. I'm not going to go involved in that right now. What I can say is that if we break the 50-week moving average, this lower support line right here where this breakout happened, where I'm covering it in this chart, is at high risk. We will tell people to sell into resistance, and at the lower support levels, if they hold, then the leadership in the S&P 500, and I'll be happy to show that to you, is that leadership in the S&P 500. Leadership stocks, it's a 500 stocks in here of our economy. The leadership continues to break down, then so goes the index here. And there are 500 of them. And there's top 10 core holdings in this S&P 500. I'm not going to go through those right now, but I will tell you one thing right now, that if they break, this index breaks, and it would cause more people to sell and ask questions later. The other thing that the market and the S&P 500 have at risk is, are they going to do anything to avoid the tax selling? Because tax selling could increase, because it just depends on what kind of agreement that Obama and the Republicans can come together. So far, it's still up in the air, and that fiscal cliff that everyone talks about is really in play. Now, if there is a resolution to that, we're going to come down in this S&P and hold support and rally back up. November, December are the two best months, but if there's not a resolution, it could cause mutual funds and other people to continue to sell the market. If there is not a resolution to the fiscal cliff, you will continue to sell throughout the first 2 quarters of year 2013. Should that be the case, we don't know what kind of an agreement that Congress is going to get off their rear end and put together with the new president, second term elect Barack Obama. And Mr. Bonner there, he's the House Republican Speaker. He's made his case. And the other gentleman that's just been elected for the second term has made his case. I will tell you, the more uncertainty that builds around these issues, the more selling that the S&P will experience. Because what drove the S&P higher to all-time 5.5-year highs can totally be unwound, because there would not be any growth that we would be looking for to support the broader part of the S&P 500. I can tell you right now that any move up in any counter rally to any of these 20-week or 10-week moving averages within the broader part of this remaining calendar year would be that you're not buying on support. Yes, you'll buy on support, but when they go up, and same thing with broader equities, you would sell into resistance. Like in a bull run, when the 10-week is coming up, every time it comes down, you buy the dip and you put the risk on trade. You buy the dip. You got the rising 10-week, and every time it comes down, you buy dips. You buy dips. But now, once you broke below it, they're not to buy. You're not going to buy the dip on it, but what you would do is buy down here at the 50-week, and the shorter term is going to be the 20-week, and it's selling into resistance. That's just the opposite of trading a bear reversal trend versus trading a bull trend on the S&P 500. I will tell you that if the S&P 500 goes into a weekly sell signal, then there's a lot more downside to the 100-week moving average, and that correction would be right around that 1320 area. Now, S&P 500 earnings can't be at $110 across the board on a 15 multiplier for one reason: lower growth. Does not support the higher multiple cash on the combined 500 companies at $110 in the S&P earnings now. Won't happen. It's impossible. So, we don't know exactly what Congress is going to do. We don't know what Obama's really going to do, and we don't know if these people are going to come to a conclusion. If they downgrade our credit rating again, that would be very bad for the market. I can tell you that QE3 with Ben Bernanke and all the printing presses are going on around the world is why they are doing what they're doing. That is yet to be resolved. Europe is going to be a drag. The Chinese economy comes back on board, it's going to give our broader S&P 500 great support levels, meaning that we can overlook Europe, but we will have to have that part of the world and that major economy, the Chinese economy, come back online. If it comes back online, everyone, we'll have support levels down here in the S&P, because in a shorter time frame going into 2013, we can overlook Europe. Europe's in a mild recession. It can go off the cliff very easily. There's still a lot of headwinds, even though all the countries over there and the IMF and the ECB and the whole thing, they're trying to do the right thing. The problem is, though, with lower European growth, it's going to take the Chinese economy to help support our broader indexes and certain names that are tied to those economies over there in those provinces and their bigger, broader picture of how our markets work with those. So, basically, what I can say is that we're at extreme risk. November, December is the best part of the year. I can tell you we're no longer overbought when the short was done up here. We were off board at 1475. We are on board again if we can come down. The ultimate place would be to come down and sell down to the 1320 area. This is where the weekly consolidation was before we had the all-time 5.5 year breakout on the S&P 500.